Welcome everyone to the 5 minutes or less Essential Finance YouTube channel. Today, we are going to add on to all of the progress that we've made our previous real estate videos. We will see how to calculate the net benefit from depreciation recapture and depreciation deduction benefits. Let's get right into it and, of course, let's finagle this bagel. The depreciation deduction benefit per year equals the depreciation deduction multiplied by the normal tax rate on your taxable income. In this case, $20,512 times 30% equals to approximately $6,000. We calculate the depreciation recapture tax. We went over this in our previous video. Link in the description for more details. But, real quick, what you need to do is sum the depreciation for each year and multiply it by 25%. For depreciation recapture, in the United States, the rule is that it's always taxed at 25%. So, after doing the sum and multiplying it by 25%, we get approximately $30,000. Depreciation reduces the tax liabilities by that calculated amount, it's the benefit cost. By mapping it out, we get plus $6,000 for the first 5 years. Then, in year 6 we take $6,000 and minus $30,000. When we do that, the answer we get is minus $24,000 because $24,000 is what needs to be repaid at the end. Tax depreciation is like a reverse mortgage. You get the benefits over the lifetime of the loan. Depreciation reduces the tax liabilities. But you have to reimburse it all at the sale. That's just how it works. Now, we have all of our cash flows and we are ready to discount them to find the net benefit or the NPV. The discount rate we will use to calculate the net benefit is the after-tax discount rate. You are probably wondering what is that and why. To calculate the after-tax discount rate, you need to take the before-tax discount rate and multiply it by 1 minus the normal income tax rate. So in this case, the before-tax discount rate we used in our previous videos was 15%. But to find the after-tax discount rate, we do 15% times 1 minus 30%. This gives an answer 10.5%. The reason why we do this is because investors require a lower return, given the presence of tax liabilities. Indeed, taxes reduce gains, therefore you expect to have lesser gains and should use a discount rate that reflects the new reality. We then can calculate the NPV by simply doing the NPV formula in Excel. Or, you could do it with your financial calculator. Just for extra validation, we calculated the NPV manually by discounting each cash flows by 10.5% each year. Sure enough, it gives the same answer. The NPV that we just found is the net benefits of the government loan. In Canada, this is called a CRA loan. In the United States, it is called an IRS loan. There you go. If you made it this far into the video, you deserve a cookie. Thank you so much for watching, you are the best. If you found this video was informative, please drop a like below. Your support helps the channel a lot. Thank you.